Well, thank you, Jen. And let me begin, Jen, by thanking you for your leadership. You have really made a difference. And Giles, you've got some big shoes to fill, but I have every confidence that you will. Congratulations to you. And everybody else, good afternoon. It is a real pleasure to be here. I want to thank the Toronto Region Board of Trade for inviting me to speak today. Really, I can't think of a better audience to talk about price and financial stability with. Giles, I'm very much looking forward to our discussion. The Bank of Canada began raising interest rates in March of last year, and 14 months later, we can see that monetary policy is working to bring inflation down. In March this year, CPI inflation was 4.3%, or roughly half of what it was last summer, when it peaked at just over 8%. We expect inflation to decline further to about 3% this summer. This is good news. But I'm not here to talk about the journey from 8% to 4% or even 3%. I'm here to talk about staying the course to price stability and getting the rest of the way back to the 2% inflation target. Monetary policy still has work to do. And I want to talk about the challenges and risks in the journey back to the target. I also want to discuss recent stress we've seen in the global financial sector and how financial stability and price stability reinforce each other. Au début de la pandémie, des forces mondiales ont fait monter l'inflation au Canada, en particulier les problèmes dans les chaînes d'approvisionnement et la hausse de la demande de biens. Ensuite, l'attaque de l'Ukraine par la Russie a causé une nouvelle poussée de l'inflation, surtout pour l'énergie et les produits agricoles. Mais des forces intérieures ont de plus en plus alimenté les pressions inflationnistes. Quand l'économie canadienne a rouvert, elle a commencé à surchauffer. Les consommateurs voulaient toujours acheter des biens et la demande des services a bondi, car les ménages voulaient les services qu'ils n'ont pas pu avoir durant la pandémie. Les employeurs n'arrivaient pas à trouver assez de travailleurs pour suivre la demande et les entreprises ont transmis la hausse des coûts aux consommateurs. The bank responded forcefully to these inflationary pressures, raising our policy interest rate quickly. We did this to rebalance the economy, to lower demand and give supply the chance to catch up. This tighter monetary policy is working. Demand for goods is slowing because higher interest rates are restraining household spending. And the supply of goods is improving as global bottlenecks ease and lower energy prices reduce shipping and production costs. As a result, inflation is coming down quickly. We expect it will hit 3% this summer, even as the economy continues to grow modestly. We are encouraged by this progress, but we expect that getting inflation from 3% to 2% is going to be more difficult. Our current projection has that happening only by the end of 2024. And in this context, I want to be clear. Our job is not done until we restore price stability. In other words, until inflation is centered on our 2% inflation target. Price stability is important because it is a key ingredient to a prosperous economy. Low and stable inflation strengthens the competitive forces in the economy and allows Canadians to plan and invest with confidence that their money will hold its value. As we outlined in April, the biggest upside risk to our inflation forecast is that services price inflation could be more persistent than we expect. For service price inflation to slow enough for overall inflation to get back to the 2% target, several things still need to happen. The labor market needs to rebalance. Corporate pricing behavior needs to normalize. And near-term inflation expectations need to come down further. So let me take each of these in turn. The Canadian labor market is still tight. The unemployment rate at 5% remains near a record low, and employment growth in recent months has been stronger than expected. But labor supply is also growing faster than anticipated as more women and immigrants join the workforce. Increases in childcare subsidies and more flexible work arrangements are improving the labor force participation of women, particularly women with young children. More people are coming to Canada, and that's also augmenting the labor supply. The Canadian population hit 39.6 million in January after a record gain of 1 million newcomers in 2022. These newcomers include permanent residents, temporary foreign workers, and international students. They're adding demand to the economy, and many are also new workers adding to labor supply. The increased labor supply is helping ease pressures in the labor market by filling job vacancies, and we are seeing some evidence that labor shortages are beginning to wane. Results from our Business Outlook survey for the first quarter of 2023 show that firms were beginning to find it easier to hire workers. But the strong demand for labor is still quickly absorbing the increased supply, and wage growth has yet to moderate. Most wage growth measures remain around the 4 to 5% range. Unless productivity growth surprises us with a strong increase, persistent wage growth in that range will make it difficult to achieve the 2% inflation target. The tight labor market matters a lot for the service sector. About 1/3 of the price of non-shelter services reflects labor costs compared to about 1/5 for goods. The Business Outlook survey also provides insight to corporate pricing behavior. Businesses report that they are still worried about their costs and they are still dealing with high demand for many goods and services. They tell us that they still expect to change prices more frequently than normal over the next 12 months. But the dynamics may be starting to change. Businesses say they expect prices will grow more slowly as commodity prices fall, supply chains improve, and demand softens. They also say they expect the size and pace of price increases to decline, which suggests that their price-setting practices are gradually shifting closer to what they were before the pandemic. We will need to see continued progress. Corporate pricing behavior has to normalize for inflation to get back to the 2% target. The other thing we are watching closely is inflation expectations. If people believe inflation will remain high for the long term, they will pay higher prices now to avoid even higher prices later. And that only makes it easier for businesses to keep raising prices. Recent surveys have shown that inflation expectations of consumers and businesses have edged down. But our latest survey of consumer expectations indicates that Canadians' concern about inflation is still high, even if it looks to be easing. And too many people still think CPI inflation will be high over the next 2 years, or higher over the next 2 years than our own Bank of Canada forecasts it will be. Longer-term inflation expectations remain consistent with the 2% target, which is a good thing. But we need to see shorter-term expectations coming down so that companies get back to normal pricing behavior and wage growth moderates. In our baseline forecast, the labor market will soften as the economy slows. Wage growth will ease back. Businesses will revert to more normal price-setting behavior, and near-term inflation expectations will come into line with the inflation target. But there is a risk. There is a risk that these adjustments take longer or stall, and inflation gets stuck materially above the 2% target. The biggest downside risk to our forecast is a severe global recession. A major international recession could come about in several ways. But one way is through global financial stress. Financial instability could amplify or even trigger a sharper slowdown in the global economy. Recent international banking stresses have been a reminder that financial instability can strike quickly. In March, the collapse of Silicon Valley Bank and Signature Bank in the United States and the severe pressure on Credit Suisse led to immediate spillovers to other financial institutions. Financial market volatility rose sharply and credit conditions tightened. Fortunately, authorities took swift and forceful actions to protect depositors, maintain confidence, and keep credit flowing. And combined with the safeguards put in place after the global financial crisis that made financial institutions and the overall system more resilient, these actions limited financial contagion. Nonetheless, as the recent government-led sale of First Republic to JP Morgan highlights, vulnerable institutions can still come under severe market stress. Here in Canada, the spillover effects have been muted, reflecting the financial stability we are known for internationally. This stability reflects a combination of strengths, including the structure of our financial system, strong risk management within our financial institutions, and sound regulation and supervision. But financial stability risks remain, and we continue to see swings in market sentiment. If global financial stress were to reemerge and prove more pervasive, the spillovers into Canada could be more significant. In addition, global stress could interact with domestic vulnerabilities related to high household indebtedness and the potential for a more protracted contraction in our housing market. So even though in our base case projection, financial stresses remain contained, I would like to say a few words about how price stability and financial stability interact. The first point is that it's not one or the other. We need both price stability and financial stability. Price stability, confidence in the value of money, is the foundation of a stable and well-functioning financial system. And financial stability is a precondition for price stability. To put it another way, the uncertainty that comes with high inflation or lack of price stability is not going to improve financial stability. And severe financial stress will only make achieving price stability more complicated. The second point is that we have separate mandates and separate tools for price stability and financial stability. So we can work to achieve both at the same time. Our primary tool for bringing demand and supply into balance and restoring price stability is our policy interest rate. In the event of severe stress in the financial system, we have a range of tools we can use to provide liquidity against good collateral and keep credit flowing. The third point is that price and financial stability can interact, and we take this into account. Financial stress will generally have implications for the calibration of monetary policy. Financial stress tightens financial conditions. This means that loans become more expensive or harder to get. In the current environment, monetary policy has already tightened financial conditions. That is the intended consequence of our policy rate increases. But if financial stress were to lead to more tightening than expected, and if this were to persist, we would need to take this into consideration as we set our policy interest rate to achieve price stability. At the same time, the financial system needs to adjust to higher interest rates. This underscores the importance of sound risk management in financial institutions and vigilant supervision to identify and manage risks as the economy slows and the cost of funding adjusts to higher interest rates. So I'm going to conclude now so we can open the floor for discussion. We're forecasting inflation to fall quickly to about 3% this summer and to reach 2%, the 2% target, near the end of 2024. The projected decline from 3% to 2% is both slower and more uncertain. With growth anticipated to be weak through the rest of the year before gradually picking up next year, we expect service price inflation to ease and overall inflation to converge to our 2% target. But several things still have to happen for service price inflation to moderate in line with our forecast, and we are watching these closely. Last month, Governing Council decided to hold its policy rate steady at 4.5% as we assessed whether monetary policy is restricted enough to return inflation to the 2% target. We know that monetary policy works with a delay, and the effects of tightening we've undertaken to date have not yet fully worked their way through the economy. If we start to see signs that inflation is likely to get stuck materially above our 2% target, we are prepared to raise rates further. We also stand ready to address financial instability. Recent global financial stresses have had muted effects here in Canada, but if more severe stress emerges, we have the tools to provide liquidity while we continue to work to restore price stability. Ça n'a pas été facile de s'ajuster à la montée des taux d'intérêt. Mais l'alternative, une inflation constamment élevée, est pire. Une inflation basse, stable et prévisible est mieux pour l'économie et pour tout le monde au Canada. La stabilité des prix est la base de la prospérité au pays. Elle protège les ménages du stress causé par les grands changements de la coût de vie. Et elle permet aux ménages et aux entreprises de planifier leurs dépenses, d'épargner et d'investir en toute confiance. C'est notre destination. On est sur la bonne voie et on va garder la cap. The adjustment to higher interest rates hasn't been easy, but the alternative, continued high inflation, is worse. Price stability is foundational to shared prosperity. The economy works better when inflation is low, stable, and predictable, and it's better for Canadians. Price stability protects households from the anxiety created by large changes in the cost of living. And it means households and businesses can budget, save, and invest with confidence. That's the destination. We're on our way, and we will stay the course. And I look forward to discussing all of this with all of you.
Well, Governor, that was a sweeping survey of the economic outlook and financial conditions. And I think, first of all, before I dig into some of the points you've made, because I think they're very much worth delving into in a little bit more detail, but I think, first of all, I'd really like to salute you on behalf of all of us here for, what shall I call it, sang-froid, I think, but steadfastness and steadiness of hand during a really turbulent period. Jan remarked that, of course, that you took over the bank in March 2020. So right at the beginning of COVID, you've gone through that whole period of significant turbulence, unprecedented times, only to find yourself riding the bucking bronco of inflation. So you've had both sides, almost in a dizzying combination. So I do want to salute you for that. It's very different from the hallowed halls of Rotman, I assume. But first question I'd like to talk about is the fact that, of course, you put interest rates on a pause twice this year so far, holding the overnight rate at 4.5%, as you've said. And then yesterday, just across the board, the U.S. Federal Reserve again increased, I think for the 10th time, the federal funds rate by 1/4 point to between 5 and 5.25%. So the spread now between Canadian and U.S. rates, they're on the upside and we're lower. Historically, that puts pressure on the Canadian dollar. I'm just wondering whether there's a case that we have to watch ourselves in terms of the ability to have that spread, or whether it in fact causes you distress with the dollar being under pressure.
Well, we worry about lots of things, but to be honest, that is not something we're terribly worried about. I mean, we raised 8 times, they rose 10 times. We've got a spread of just over 50 basis points. Frankly, by historical standards, that's not large. I mean, look, of course, there are limits to everything. That divergence can only get so big, but we're not feeling any limitations at the moment. The second thing I would stress is that there are 2 key pillars to our monetary framework in Canada: the 2% inflation target and the flexible exchange rate, which is something I didn't talk about. And the flexible exchange rate is what allows us to run a monetary policy that is independent of our biggest trading partner, the U.S., and that is geared to what Canada needs. And it allows us to control inflation in line with our inflation target here in Canada. I mean, to put it the other way, if we had a fixed exchange rate, basically we would have to move interest rates in Canada lockstep with the U.S. And so effectively, monetary policy would be run by the U.S. Federal Reserve. The flexible exchange rate allows us to run a monetary policy that is geared for the needs of Canada. And so, yes, you will see some, that means you will see some divergence. I mean, if you look at the big sweep, look, we've all been through the same pandemic. Our economies were all very weak. They all came roaring back. Inflation has gone up. The big sweep of interest rates is pretty similar. But, when you step back, inflation didn't go quite as high in Canada as it went in the U.S. Inflation's a little lower today than it is in the U.S. And so perhaps it's not surprising that interest rates or policy rates are a little lower in Canada than the U.S.
No, that makes sense. I mean, I just remember my days as an economic journalist, and I remember back in around 2000 when there was huge pressure, maybe 1999, huge pressure on the dollar, and I sent a correspondent to Chicago to the currency markets to talk to, why are you selling the dollar so short? What do you know about Canada that we don't? And the answer was they knew nothing. They were acting on the spread, pure and simple. So
hopefully we're out there more, so they've learned a little more about little more about Canada. I mean, the other thing. Yeah, no, that's fine.
No, I think that's a good point. You talked about the fact that, and others have mentioned this, obviously, that there's a kind of a lag time in the impact of interest rate increases, and people say between 12 and 16 months is what I've seen. It always surprises me because I always sense that the impact is so immediate. You raise interest rates, people respond pretty quickly. Mortgage rates go up. Vehicle loans go up, and all the rest of it. Is the lag really there? Is it as long as people say? Because if it is, you've had 8 rate increases in the last 14 months. A whole bunch of them have taken place in less than a year, and so that would imply that there's still a huge amount of firepower left in the rate increases you've already made. In which case, how much concern about overshooting then?
Well, you're right. There is a lag. As Milton Friedman famously said, the lags of monetary policy are long and variable.
It's helpful.
Yeah, helpful. We typically think they're between a year to 2 years. You're also right that some parts get transmitted very immediately. I mean, we change the overnight rate a nanosecond later. Other financial prices start to change the same day. Probably mortgage rates will get changed. You start to see pretty quickly that gets transmitted into the housing sector. Other things you buy on credit, like cars, yes, you'll see it get transmitted pretty quickly there. But other parts of the economy, particularly the service price, the services sector, it takes time for monetary policy to feed through. As people renew their mortgages at a higher rate, all of a sudden they're paying more for their mortgage. They've got less money to go to the restaurant. So then you start to see it flow through on services. But that takes time. That's why there's a lag. So yes, we are very conscious that we know there's more to come. And we started raising rates a little more than 14 months ago now. So you can already see the effects. You can see it very clearly in the housing market. You can see it in household durables. You can see it in housing prices. You can see it in things like appliances prices, furniture prices. The inflation in those areas has really come down. Services prices, inflation, though, is still not really come down much yet. It's stopped going up. It's starting to tick over, but it's still pretty high. So yes, we're trying to balance the risks of over-tightening versus under-tightening. I mean, the lesson from history is you don't want to be half-hearted, and you certainly don't want to loosen prematurely, because if inflation gets stuck, it's really hard to get it back down. On the other hand, we know that, yes, this is slowing the economy. We actually need the economy to slow, to let supply catch up, take those price pressures out, but we don't want to overslow it. We don't want to make this more painful than it has to be, and that has a lot to do why we paused. The last 2 decisions, we've stayed at 4.5. We're using this as a time to, we know we've done a lot, we know there's more coming through, and we're using this as a time to pause and assess whether monetary policy is sufficiently restrictive. Are interest rates high enough, in other words, to get inflation all the way back to 2?
It's interesting that the service side is stickier than the goods side. And I only say that because when this began, if you go back to 14 months when inflation was at its 8%, there seemed to be this view that a lot of the supply chain, that a fair bit of the inflation was supply chain generated, was really not superheated demand, but the horrible Russian invasion of Ukraine, the Chinese lockdown that was so extensive. So all of these impacts that were coming from abroad that really disrupted supply chains, with scarcity forced up prices. And yet now we find ourselves where goods prices are coming down, but there still are supply chain disruptions, interestingly, considerable ones. And yet it's on the services side where you're seeing the stickiness. How do you explain that?
Well, to some degree, it's not too surprising that you've seen more declines in goods and services, and for a couple of reasons. One, we all remember during the pandemic what happened. We couldn't go out. We bought goods. You know, we bought new furniture. You bought lawn furniture. You bought bicycles, home gym equipment, and at the same time that the global supply chains were really gummed up, and so you saw this big surge in global goods price inflation. You know, as our own behavior has normalized, we've shifted a bit back to services, and we've worked through these global supply chain problems. You've seen a lot of the pressure on goods prices come off. Goods price inflation has come down. But, you know, as we were, you know, after we bought all these goods, what happened? The economy reopened. We wanted to catch up on all those services. So then there was, you know, a huge surge in services. Businesses were having real trouble hiring enough people to keep up. You know, the first thing you saw, it was harder to get a booking. Then you saw the prices go up. And to some extent, you know, Canadians are still catching up. And we still think, yes, the economy is rebalancing, but it's still in excess demand. I mean, we've still got upward pressure on those services prices. So it's not surprising in a sense that that's taking longer. The other reason it's taking longer, and it goes back to the previous question, is that monetary policy takes longer to affect services than goods, because many, you know, especially big ticket goods, you often buy those on credit. You don't go to the restaurant on credit, hopefully.
It's normally you do.
So, you know, that does take longer. And, you know, I would say so far, look, we're within the window of our normal lag. But as I stressed in my opening remarks, there's some things that we need to see happen that we haven't seen yet. And so we're really focused on, you know, if those things don't fall into place, we are going to have a problem.
The 2% target, which you mentioned, that's your definition of price stability. It has been for more than 20 years. I think you renewed that 2% target a year or so ago. But all the changes that have taken place in the economy, the technology revolution, the geopolitical turbulence, the shift in some ways of supply chains from global to continental, all of these changes, does that not suggest that 2% is going to be extremely hard to get back to after that long period of stability? You know, we've got a period of turbulence, and in some ways we're probably going to have to get adjusted to that. Is 2% still a reasonable target? I know you're going to say yes, but explain why.
Yes. A couple points. First of all, like we've had a 2% inflation target for 30 years. And I know whatever moment we're in, we think the world has changed, it's a new pivot, there's a new trend. This isn't the first time things have changed in 30 years. There have been shifts in trends. There have been big changes in the economy, and the reality is we've been served well by a 2% inflation target over that span of history. The second thing I would say is that, look, there are some big forces on the economy. Climate change is going to be, you know, there's a big adjustment to happen. Supply chains are becoming more resilient. You know, that's probably going to be helpful in the longer term because there can be less supply chain disruptions. But, you know, getting there is probably going to build some extra costs in. There are certainly some geopolitical tensions that could make trade more difficult. So there are some big, and we've got, you know, baby boomers are retiring, workers are becoming scarcer, labor force growth is declining. So there are some big forces in the economy. Mm-hmm. And I don't want to minimize the fact that, yeah, I mean, if you're running a business, you're going to have to adjust to those. You're going to have to figure out your business model on the back of those forces. If you're a household, you're going to have to figure out how you're going to adjust to those. But adding some extra inflation in is not going to make those real adjustments any easier. It's going to make it harder. It's going to make the price system, you know, we're not going to get the price signals clearly from the price system. People are going to have to cope with inflation like they've had to cope for the last 18 months. Look, ultimately, monetary policy can bring demand and supply in line with supply and get the inflation target. You know, whether it's easy or hard, well, we'll see, but you know, it's worth it to get to that destination, because just living with the ongoing cost of inflation isn't going to make any of these adjustments any easier.
No, I'm sure that's true. It's just the attainability of it, I guess, right? And whether, monetary policy perfection is the enemy of the good, the 3%. I don't know. That would be the question. But enough from me. We have some great questions from the floor. So here's one. How are you thinking about the future of the housing market? Talked a little bit about that, but the housing market, the potential for mortgage defaults, which is, of course, you're reading about a fair bit now, and the dynamics of this market influencing inflation.
Well, my short answer is in 2 weeks, we're going to publish our financial system review, and we'll have a lot more to say about the housing market. But look, a couple of points. The housing market is a very important part of the economy, but I mean, we have to look at the whole economy, and we have to basically bring demand and supply into balance in the whole economy to get inflation centered around our 2% target. We certainly look at the housing market closely, and we are very aware that we've raised rates historically very rapid pace, very forcefully. I think that's actually been really important in keeping inflation expectations anchored and rebalancing the economy. You can definitely see the effects very quickly in the housing market. Housing activity, which was extremely elevated through the pandemic, has weakened very sharply. Housing prices that went up about 50% in the first 2 years of the pandemic are down a good 15, 16% on a national basis. The housing market is still weakening, it's still declining, but more slowly. And it's a big country, and depending where you are, some places are stabilizing, some places are still going down. I mean, we overall, our own forecast is that it will continue to weaken for a bit and then start to pick up in the second half. There are, look, especially being in Toronto, as you'll be well aware, there are some underlying supports for demand. We've got strong immigration into this country. I mean, those new Canadians, new entrants to the economy, they're adding labor supply, which is really helpful for easing some of the pressures in the labor market. But of course, they're also adding demand. They need housing. They're getting jobs. They're getting incomes. They're spending them. They're adding demand. So, from a monetary policy point of view, inflation's not going to go away by itself. We still have some work to do there. And we are acutely aware that some Canadians have been very squeezed by the interest rate increases. I mean, if you took out a variable rate mortgage, you bought your house near the peak, you very quickly saw your interest rate payments go up. So we are looking at the overall stress on the household sector. If you look at mortgage delinquencies, they were actually extremely low during the pandemic. They are coming up, but they're still only just getting back to pre-pandemic levels. So that is something to watch, and we actually have a lot of information on as people roll over their mortgages, delinquencies, defaults, late payments. So that is something we're watching, but certainly at this point, it's more getting back to normal.
So you're not seeing any sort of crisis point yet?
Look, I don't want to say there aren't some individuals who are really feeling the pain. But if you look at the household sector overall, we're not seeing, alarm bells.
Okay. You talked a bit about when you're talking about the U.S. in particular with the takeover now of 3 banks, and talked about the Credit Suisse situation. So if financial stability deteriorates, you obviously said that interest rates, there'd be pressure on interest rates, downward pressure on interest rates, presumably, if that were to get much worse. The question here is whether the risks to the upside on inflation are still of greater concern than the downside risks of financial instability.
So we put out a forecast a few weeks ago, and as I articulated, it does have inflation coming down pretty quickly to 3% this summer, and then more gradually getting back to 2%. Look, there are some risks on the upside, some risks on the downside. I talked about those in my remarks. Certainly on the upside, the thing we're most worried about is this stickiness in service price inflation. On the downside, yes, if there was severe financial stress and it spilled into Canada in a big way, you would get much tighter financial conditions than we intended to put in place. You get a much sharper slowing in the economy. When we look at the risks, I think we think the risks to our forecast are reasonably balanced on both sides. I will say that with inflation still running well above our target, and having been well above our target now for a good 18 months, we are more worried about the upside risks. It is, and Canadians they've been patient with us. We've been saying inflation's coming down, it's going to come down. We've acted forcefully. It is working. It is coming down. But we're still just over 4%. It is important that we stay the course and get it back. What you don't want is inflation to become entrenched, because the lesson from history is if that happens, we'd end up having to raise rates a lot more to get it back, and it would be a more painful adjustment. So we are conscious of that lesson. But as I said, we don't want to over-tighten. We don't want to under-tighten. We're looking for that sweet spot, but it's a delicate balance.
I mean, just back to the entrenchment, and people tend to talk about the wage price spiral as the thing you're trying to avoid. We just had a significant strike, a public service strike in Ottawa, and a settlement that was considerably less than what was sought, but still well above your target. And so I wonder there whether you're concerned about this entrenchment, this setting in of a wage price spiral, notwithstanding all your efforts.
Well, yes, we do worry about that, but I'm going to be a little more optimistic here. When I look at where we were last summer, I think we are feeling better than we were last summer. Inflation, was over 8. It's now just over 4. We think it has come down. Canadians are feeling some relief from high inflation. They're going to feel some more relief. And I think that has reduced the risk of a wage price spiral, a sort of self-fulfilling, sustained inflation. Inflation expectations, by acting forcefully, by raising rates rapidly, we sent a clear signal. We are serious. I think, and you saw inflation expectations did stay well anchored. So when those global supply chains started to work out, inflation did come down. It hasn't got stuck really high by a sort of self-fulfilling. So, I think that risk has gone down, but as we highlighted and I talked about at length, there's still a risk that we get stuck somewhere, and then we're going to have to sort of restart, which is going to be tougher.
We've only got a minute left, so here's a great question to end on. I think it's probably the one everybody wants to hear the answer to, although you may end up being fairly tight-lipped on it. It's I know the sphinx-like nature of the central bank, but although you've been remarkably candid today, so I appreciate it. When can rates come down is the question. So the question really is, I'll read the question because it's worth reading, which is, can you describe the circumstances that would be needed for a rate decrease and whether such a decrease could occur in advance of the reported inflation rate hitting 2%?
Well, I think you predicted my answer very well. Maybe you should be a forecaster. Let me say two things. The first thing is, our target is 2% inflation. We forecast inflation. The interest rate is the instrument that we use to make that forecast come true. So what happens to interest rates is going to depend on what happens to the economy. We raised rates very rapidly. We know there's lags. We've taken a pause. When we did it in January, we called it very deliberately a conditional pause. It's conditional on inflation coming down broadly in line with our forecast. And if we start to see evidence accumulating that we're getting stuck, we are prepared to raise rates further. And so I think it's pretty clear from that characterization that we're really not thinking about interest rate cuts. And as I said earlier, the lesson from history is cutting prematurely will probably, that's going to end up being more costly down the road. So yes, it is too early to really be thinking about interest rate cuts. That doesn't mean that, yes, at some point we will get there. The economy is rebalanced. Inflation is clearly on track. You do have to be forward-looking. we know there's lag, so you've got to be forward-looking. So it doesn't mean that you have to actually be all the way back
target.
before you start thinking about that. But it's going to depend. I mean, we may get 2% inflation, but there may be ongoing pressure in the economy, and you need to keep interest rates higher just to keep 2% inflation. Or it may be that there's less pressure, and you can bring them down, and we'll take those decisions.
So the answer is, everybody, wait and see. But that was a great answer. I think that's all the time we have right now. But thank you very, very much, and you're welcome back to the Toronto Region Board of Trade anytime. But
Thank you.
Thank you so much.
Very good. Appreciate it.